verified. Hello, hello, salut. Merci. Hello, everyone. Welcome. We got a lot to talk about. I'm going to promise you 3 things from this presentation. We're going to discuss risk factors in stablecoin design. We're going to take a sledgehammer to the Stablecoin Trilemma using data, and we're going to pick on consultants a bit. Any consultants in the audience? Oh, there's got to be at least one. Don't worry. Don't be shy. All right. So if you've been in cryptocurrency for any amount of time, you probably often sleep a bit like this. Like, let's flash back all the way to 2020. And back then, there was a ton of money printing, and the narrative was that cryptocurrency was going to save us from hyperinflation. Flash forward to 2022, and the best performing investment was probably dollars. If you'd bought cryptocurrency, you might have seen your portfolio drop like 95%. Funny enough, if you bought stablecoins, you also might have seen your portfolio drop about 95% if you happened to pick the wrong ones. So, of course, if you were in UST, USDN, it wasn't a very good year for you. They think they're still floating around like 5 pennies or something like that, but not great. Stablecoins, in my mind, are the killer use case for cryptocurrency. Was anyone at the Stable Summit this past weekend? There we go, there we go. I see DeFi Dave walking in. It was a great event, and it was the first stablecoin-focused conference with a lot of big brains talking about stablecoins, and I'm a big fan of stablecoins, but they're a terrible investment because at best, they'll be worth $1, but there's still a ton of risk factors that mean it might go to 0. This is just the nature of the beast. If we're going to be moving liquidity on-chain with stablecoins, we're adding risk factors, right? There's no way around it. It's a derivative. It's like when you make a photocopy, it's never the original. So let's talk about some of the risk factors in stablecoin design. The initial stablecoin design choice was, of course, Tether USDT. It's got the simplest model. You give them $1, you get $1 back. And you can already probably imagine, if you're new to stablecoins, there's a million things that can go wrong with this. Fortunately, most of the big centralized stablecoins have actually been redeeming dollars for dollars. But you can imagine where they just keep the money. And most of them, in fact, do have functions built in which they can brick their funds. You could imagine this could have killed stablecoins, but thankfully they've mostly been using it. If you're selling, if you're trying to use stablecoins to transact with North Korea to sell nuclear secrets, you probably should have your funds bricked. I think we can agree with that. If you hacked a protocol, it's probably a good use of bricking funds. Nonetheless, there's a ton of other risks that come about. Like, Tether has been subject to nothing but a nonstop torrent of complaints and confusion and concerns, what's called FUD in the industry, fear, uncertainty, doubt. They publish attestation reports. There's a lot of people that claim the attestation reports are not sufficient. Maybe they're lying in them. We're not here to judge whether Tether is lying or being honest. Just know that that's a risk factor that a lot of people are concerned about. And then this also means there's the flip side risk factor, which means that you're seeing governments zealously trying to prosecute and attack Tether. So back in the day when all Tether was doing essentially, allegedly, was putting it into the bank and earning yield on it, and yields were about 0, you could see where you could easily go out of business just trying to stave off all the legal fees. Now Tether's got a pretty good business now that rates are like 6–7%, so they're earning really good yield on this. But there's been enough questions about Tether that it opened up the way for USDC and other redeemable stablecoins. So of course, USDC was cooking along. It looked like it might catch Tether, and then earlier in March, USDC made the mistake of keeping their money in banks. So what else were they going to do? They were going to hide it under a mattress. But by keeping it in banks, they chose one that very popular in Silicon Valley Bank. And there was a weekend of terror where USDC and everything exposed to USDC was at 90 cents. There was potential risk is going to depeg completely. So it was like, what are we supposed to do to be safe in this? Stablecoins are supposed to be the safe thing to do, and there was almost nothing we could do. Well, this is why all the various risks we've seen with stablecoins and their exposure to centralized points of failure have given rise to this idea of algorithmic stablecoins. And now, we know that the consultants in the audience have done a really good job of coming up with ways of further refining this. There's endogenous, exogenous. We're not going to get into it just because we think it's still too premature to come up with these rigid frameworks because there's still a ton of innovation. But what we mean by this is just on-chain stablecoins. Stablecoins where usually you're lending an asset like Ethereum and you're getting a stablecoin back. And this also is tremendously risky. You're just trading off one set of risks from centralized stablecoins to this other set of risks of decentralized stablecoins. So you can imagine with decentralized stablecoins, any of the favorite hacks you've seen on the front page of Rect News, that's a risk for stablecoins that are on chain. So we're talking about oracles. Very often oracles are subject to manipulation. And in some cases, like Mochi's USDM, they're just hard coding the oracle price to 1, which is allowing for certain arbitrage attacks. There's governance attacks that can come from flash loans where you like accumulate all the governing power, like happened to Beanstalk. There's just simple smart contract risks. Maybe you have a bug in the code. Like most people, even if you're a coder, can read through all the code in Etherscan and still can't quite audit it. So there's a ton that can go wrong. But there was one interesting trend that came from the collapse of UST, which was the largest stablecoin collapse that I've seen. This was in 2022, triggered this horrible bear market we've been in for some time. And this was at the time of its collapse. People were looking at it and saying, all right, looks like this like about 80% backed by Luna. And around that time, it became severely in poor fashion to have an under-collateralized stablecoin. Nearly every stablecoin decided to ditch this idea that it could be under-collateralized and move to an over-collateralized model. Now, as we're going to see, that's not necessarily like necessary, but this is like a trend that's happened. So enter the Stablecoin Trilemma, because at Stablecoin Summit, I think nearly every presentation touched on this at least once. It's become very popular as people have looked at these kind of trade-offs to say, well, I think we see something like a trilemma. And I suspect it's consultants, because if you're a consultant, like anyone at McKinsey can come up with a 2D Gantt chart, but if you have a full-fledged trilemma, even if it's backed by flimsy data, you can probably get promoted. So with the concept of the stablecoin trilemma, if you look at the USDCs, the redeemable stablecoins of the world, they're completely not decentralized. But you get the other two prongs. You get capital efficiency and you get a peg. And then they looked at the on-chain stuff and said, well, it's not fully capital efficient. What this means is that with redeemable stablecoins, it's usually you trade $1 for $1. On-chain, you want to have like a little bit more collateral backing it. So they tend to be over-collateralized. Capital efficiency is the inverse of the collateralization ratio. So if you're 2-to-1 backed, you're only 50% capital efficient. If you're 4-to-1 backed, you're 25% capital efficient, et cetera. So any of the lending-based stablecoins that are over-collateralized, they lose in capital efficiency, but they get decentralization and they get peg. And of course, Do Kwon's UST didn't do so good with the peg, but claimed the other two. So we were really interested in taking a look at this, because we were like really interested in looking at how we could break this down. We found one paper that was pretty interesting. They presented a very different stablecoin trilemma with some different factors, and we definitely recommend people read it. But we know it's after lunch, so we're not going to like get into this much math. Don't worry. Just needless to say that like there are ways attacking this analytically and rigorously using data. I'm a huge geek, so I was pretty interested in if there was similar stuff for this aforementioned stablecoin trilemma. So I went looking for data on the stablecoin trilemma, and here's what I found. There hasn't been a lot of rigorous attacks on, is this actually valid? So for the remainder of the presentation, we're just going to dive in. I'm going to present a very condensed version of all the research I've done on the stablecoin trilemma. It's all available on my blog, which you can find at the end of the presentation. But let's dive into these three prongs of the stablecoin trilemma. Most people argue that the peg is probably the most important, because if your stablecoin is worth 0, it's lost its peg, it's useless. There's actually a couple ways of attacking this question of the peg. The first is just the binary. Is it 1 or is it 0? And this is, of course, what everyone cares about. But when I looked at the data, there wasn't a ton I could tease out of it. The full explanation is on the blog. But basically, like, if your coin's gone to 0 because like someone had a secret key where they could steal all the money, it doesn't really matter whether it was capital efficient or not. It's because someone stole the money, right? If there was a design bug in the protocol, it doesn't matter if it was decentralized or not. There was just a bug, and maybe a better implementation, it would have been successful. So this binary 1 to 0 wasn't very informative when I was looking at the data behind the peg. But what was kind of more informative was looking at just how closely, if it is maintaining peg, does it keep to the peg. So I specifically picked a window to put everything on an even playing field since the launch of Curve USD a couple of months ago, up until slides were due like a week ago. So unfortunately, I didn't get Go in there, which was just released this weekend. But it gave us enough data on a kind of an even time field. Like not so good for TUSD, because TUSD has been undergoing a lot of FUD, but we missed like the USDC DPEG weekend. And you can see that if you just plot the prices based on CoinGecko, like you can kind of tell visually which one's keeping the peg and which one's not. There's a few ways to attack it from here. You can use standard deviation is what I used. There's also ways of using like mean average error to $1, which is useful for like liquidity USD, which tends to float above $1. And some people say that's not so bad. Or you can use mean average, lower mean average error, which is how often does it just go below that dollar peg. But for various reasons, like I stuck with standard deviation, because if you just buy something at $1.10 on the open market and it goes down to $1, you still like lost 90% of your money. And note that these are all backwards looking. If you're interested in forward looking, can you predict a 1 to 0 depeg? There's some interesting research that's been done by Xenophon Labs using Shannon entropy in curve trading pools to predict future depegs. So this might actually be the most important research that's being done in the space, which is the forward-looking, how do you actually predict a depeg? But we're just looking at while it's pegged, how closely is it staying at peg? So using this, we were able to come up with a list of results. Some of the ones you might expect, a lot of the redeemable ones are very good at holding one-to-one to peg, whereas some of the more decentralized ones like have a looser peg. And now that we've got the data, we can start doing things like plotting it analytically, rigorously. So throughout, we're going to just make note of which of these factors actually contribute to a big market cap. Here in the bottom right, you can see USDC and USDT did pretty good. We don't know if that's the tail wagging the dog. Did they become big because they're good at holding their peg, or are they big enough that that helps them hold their peg? That's a question for Plato. A couple quick notes while we're on the subject of peg. If you're on-chain, there's actually no way you can calculate the price of a dollar, right? Dollars only exist off-chain. Everything on-chain is a derivative of dollar. So the question of how do you calculate what a dollar is worth on-chain is not trivial. Curve USD's approach is to take 4 different coins, stablecoins, see what their price is roughly on-chain, and then essentially weight it based on how close it is to peg. So like TUSD during this period was going a little wild, but Curve USD still kept a tighter peg than the TUSD and some of the other stablecoins. And then finally, like you might say that peg's the most important factor, but there's plenty of cases where like you don't necessarily care about holding a strict peg. FPI, Frax Price Index, is a stablecoin that's pegged to inflation, so it's good if it's going up, right? But you might argue, okay, it's going up, but it's still pegged to dollar plus inflation. But there are examples of stablecoins that are sacrificing peg. Aladdin DAO's F of X protocol is a pretty interesting stablecoin-ish coin that's launching. They're essentially taking Ethereum and cleaving it into FETH, which is trying to take Ethereum but about 10% of its volatility, and then putting the rest of the volatility into a high volatility XETH, which functions as a leveraged long. Their white paper basically lays out the case that the FETH is not strictly a stable coin, but it's stable enough that you could do things like plan for employee expenses, plan for rent, but still be exposed to some of the upside if the market does go up. And then, of course, LUSD, as mentioned before, it was more focused on kind of keeping between 90 cents and $1.10. It's mostly stayed above $1 because basically when it's as a lending-based stablecoin, when people are like rushing to repay it, there's a huge demand for LUSD that kind of pushes the peg above $1. So most people who hold LUSD don't mind, but LUSD was basically saying we're going to sacrifice the peg and we're going to focus on the second peg, second prong of the Stablecoin Trilemma, decentralization. This was the one that was maybe toughest to quantify because I couldn't even find a definition that everyone agreed on. It's one of those things that people are like, I can kind of recognize it when I see it. So I just used that. I used my Twitter account to get a statistically significant sample of votes from people, saying on a scale of centralized to decentralized, how do you consider this coin to be? And the results were pretty good. My audience tends to be biased towards Curve, so it put Curve USD above LUSD. It should probably be flipped, but at least they're in the same reasonable tier. And of course, like the USDCs and USDDs of the world were extremely centralized. Given this data, now we can, for example, see how does PEG correlate against decentralization. In the bottom left corner, you can see that all the redeemable stablecoins, they are not very good on decentralization, but they are pretty good at holding their peg. On the right-hand side, you see more of the redeemable stablecoins. They did 50-50, right? 50% of them, their peg's pretty wild, but 50% of them are about as stable as the redeemable stablecoins. And then, of course, the stablecoins that are living off-chain and have access to the most liquidity get the most market cap, the USDTs, USDCs. Finally, we're going to look at the third prong, which is capital efficiency. And this is where we suspect we should see most of the trade-offs, because most of these stablecoins are trying to basically become as over-collateralized as possible as a way of staying more stable. Fortunately, most of the stablecoins did at least provide numbers on their collateral backing, so we were able to use these numbers. Now, who knows if they're accurate? In some cases, they've been called into question. But this also kind of mostly maps to what you would expect. You see the redeemable stablecoins don't have a huge collateral backing. They're much more efficient. And then you see SUSD is really focused on, they have 5-to-1 collateralization ratio at the moment. LUSD is 2.5-to-1. So this is the cleanest correlation chart we've seen amongst any of these prongs of the stablecoin trilemma. Down in the bottom right, you see all the redeemable stablecoins that generally have high capital efficiency. They also keep the tightest peg. And in the upper left, you see the SUSDs and LUSDs, the highly over-collateralized ones, have the loosest peg. And this, you might be asking, like, isn't this going the wrong direction? Because weren't they becoming over-collateralized to protect their peg? But it seems like the data is showing the opposite. And then on the question of efficiency versus decentralization, we got, again, it's a design choice is the way I like to look at it. In the bottom right, you see that most of the collateralized redeemable stablecoins are, of course, very capital efficient, but USDD decided to be over-collateralized. They said, all right, we're going to take $2 for every dollar. And now that they can take that and earn pretty good yield, that might be a good business model. Similarly, amongst the decentralized stablecoins, like you do see some of them are very capital inefficient, and some of them push very close to capital efficiency. It's worth noting that Frax was under-collateralized about like 5% or so until it became out of fashion, and it functioned and held its peg very well. So I do consider it to be mostly a design choice. And then, of course, the ones that take a dollar for a dollar get the highest market cap. All right, let's put it all together. We've got now 3 dimensions, and we're dealing with 2-dimensional slides. How can we actually visualize what's going on here? How can we present the Stablecoin Trilemma in a way that a dumb person like me can understand? So we're going to try and do a 3-dimensional chart here. So what's going on here is we've taken all the data we've collected and we've basically ranked it in a scale where 0 is scoring the absolute best and 1 is the worst. In other words, if it's closest to where the 3 lines intersect at the origin, that's a absolutely dream stablecoin. It's keeping peg, it's decentralized, and it's got efficiency. If we're positing a trilemma, we would expect that we would see the coins fall into one of these extremes. So for example, a CBDC would be completely centralized, but perfect peg and perfect capital efficiency. Similarly, at the top, it's losing out on peg, and at the right, it's losing out on capital efficiency. Makes sense, right? Now, if we're positing that there's going to be some sort of trilemma, we can sort of imagine some sort of mesh, some sort of boundary beyond which none of these stable coins can pass. So in other words, it's going to be entirely possible that you could have a stablecoin that is worse on some of these factors, like this red dot here. It's worse on efficiency, decentralization, and peg, so that's theoretically possible. But you're not going to be able to get one that's close to the origin. And you can debate what the mesh should look like, the boundary. Maybe it's curved. I put it here as a flat screen. The important thing here is that for there to be a trilemma, you can't actually get something too close to the origin. So here's what it looks like when we actually look at our experimental data. We'll start with USDC. Which is pretty close to a CBDC. It's very capital efficient. It's very good at keeping peg, other than that weekend in March, but it's not so good on decentralization. Indeed, all the redeemable stablecoins kind of cluster here around this corner. So similarly, we can take a look and we can very easily find examples of other stablecoins that would clearly fall outside of this mesh. But we can also find plenty of examples of stablecoins that fall very much inside this mesh. These are stablecoins that very close to the origin. DAI, I think, is a very good example in that it didn't give up too much in the way of peg relative to the redeemable stablecoins. It's better than some of them. It didn't really give up that much in the way of capital efficiency, but the audience that was following me said that they're much more decentralized. Similarly, Curve USD, it's about 80% capital efficient. It could be about 90% if everyone was doing the max degen leverage, but it's much stronger on peg than even some redeemable stablecoins, and it's very good in decentralization. So I think that what this says to me is not that the stablecoin trilemma necessarily needs to be thrown out, but it's a little bit reductive. Another way of looking at it is you could do spider graphs for everything we just did. Here we're reversing it, so 1 is where it ranks really good. USDC is really good at keeping peg, really good at efficiency, but not so good at decentralization. If this were a true stablecoin trilemma, you would probably assume that you can't draw a much bigger triangle than this. But we can. Like as mentioned, Frax is really good at keeping peg. It was really good at decentralization compared to some of these, and even for times been more capital efficient than some of the alternatives. There's a lot of cases where you can actually get some pretty good improvements on this. So I would posit that the stablecoin trilemma is basically just like a mental filter that we're putting on ourselves, where it used to be the case that you said it's impossible for a human to run a 5-minute mile, and then someone did. And it was impossible to run a 4-minute 30 mile, and then someone did. If you're accepting the stablecoin trilemma, you're basically just limiting what you're saying you're going to be capable of doing with your stablecoin and your design. all of these involve risk and reward trade-offs, right? We said from the outset that there is no free lunch. If you're centralized, there's one set of risks. If you're decentralized, there's a different set of risks. So none of these are completely erasing risks, but we can still look for improvements on all these dimensions. One really good example, LUSD. They have a talk at the Stablecoin Summit, and they're also speaking here at ETHCC about Liquidity V2, in which they're also rejecting the Stablecoin Trilemma. They said, we figured out a way to improve on all of these fronts, and we'd encourage all of you to do the same. But that being said, like, we know that consultants don't get paid if you don't have like a nice trilemma. So we're going to propose, let's just put this one aside for a second. We're going to propose a new trilemma, and this one is just for the consultants. We're going to call it the Big Three Consulting Firms Trilemma, which is that if you've worked at one of the consulting firms, we'll have you in crypto. But if you've worked at two of them, you're probably like living in PowerPoints, and you should stay out of crypto. Thank you, everybody. This has been Risk Factors in Stablecoin Design. I think we have time for questions. We have time for questions.
Thank you. Hi, I have a couple questions.
Please.
So, kind of like unrelated. The first is, when are you integrating Llama in CurveSim?
When are we what, sorry?
Integrating Llama in CurveSim. Like,
Llama, oh, that's a good question. I don't know the answer to that. I'll check on that for you. Do you have a way of following up?
Sure. And the other question is, what do you think is kind of like a goes rate? It's like at 1.5%, right?
I think it's about that, yeah.
And what do you think is going to be like its impact on the overall lending market? Because right now the rates for like USDC and all that stuff are like 3%, and the DSR is at 3% and something.
Yeah,
and
that's a
Go
really
is like being minted at like.
Yeah, it's a really good question. I guess I wouldn't be able to offer a good prediction on that, to be honest. I'm still trying to figure out which stablecoin is going to hit $2 first.
Any other?
Yeah, thanks. That's a really interesting talk. I wonder, there's one extra element here to add to stablecoin adoption and growth, right? One of them is like the network effect. So even if we come up with like a better stablecoin here, and we're like, okay, this stablecoin is great. It's 10% better than Tether in all of these dimensions. But there's like 100 billion Tethers out there that you can use and do whatever you want with right away. So I think to overcome that, the design of the stablecoin, it has to be much better, or have like a really sort of aggressive go-to-market strategy. So I was wondering, in the research, were there any sort of things that you saw would work that would like actually have a chance of taking down, you know, essentially 80% market cap coin down to, so, you know, like how do you compete in that market, right, where the network effects are so hard? Yeah,
it's a really good question. And I do agree that one of the problems with this idea of a trilemma is that there's a ton of other factors that people aren't considering. I think the utility of a stablecoin, how many chains does it live on? Is it easy to buy real world assets using the stablecoin or not? I think that there's a lot of things that you could add into it. So I didn't get a chance to quantify all that, but I actually think that that would probably be like a much more interesting thing to look at.
Hi. So maybe I'm just not up to date too much, but I was wondering, why does Curve USD have much higher capital efficiency than LUSD, for example?
So that's just a design decision. Also, users can set essentially when they take out a loan using Curve USD, they can choose kind of how up to the edge they'd like to get. The best you can do is like 90% or so LTV, which allows for like 9x leverage. And that's like an issue with lending-based stablecoins. You can't actually get one-to-one. And that's where a lot of the concept of this trade-off came from. Because if you could do one-to-one, that would allow for like basically infinite leverage, right? So it doesn't actually work to get like right up to the edge. And most people don't feel comfortable at 90%. So the typical average that people have taken out so far is like 80%.
Hi, can we hear your definition of decentralization? Of like.
Oh yeah, it's my definition of decentralization. So this is one of those things I recognize when I see it. I've heard it be like the closest to a definition of decentralization that I've seen is the like number of unique wallets that it would take to execute a majority change on a protocol if it's actually on chain, and then the off-chain ones wouldn't count because that would just be subject to off-chain.
but like stablecoin, like when you asked in Twitter, like which stablecoins were more decentralized, like did you get any other questions, like what do you mean by this question, or people just leaving questions or comments regarding the first?
Yeah, thankfully no one pushed back on it. So the text of the question was simply, how decentralized do you consider blank? And it's open to interpretation, but you can see where like there's some interesting votes where like USDC is as centralized as it gets, but still people were like coming up with like shades of like how decentralized is USDC versus USDT. Like in my like book, it's an easy vote, but now we can at least like kind of fractionally say that people think Tether is slightly more decentralized for what it's worth than USDC.
Thank you.
All right.
What would you consider more decentralized? A stablecoin, on-chain stablecoin that is available on every L2, every alternative L1, or something like LUSD that has, let's say, it is much more difficult to implement a change at the protocol level, but that would only be available on Ethereum, let's say.
All right, so I think I need a bit more data to answer the hypothetical, of course, because for all I know that one that's across multiple chains, maybe it's got one signer that can execute everything, right? In which case it would not be at all decentralized. In my opinion, like Liquidity is the gold standard for decentralization. Like they're so decentralized they don't even operate their own front end. They allow other people to operate front ends and take whatever fee they would like. So like that way there's no like single place that agents could come and gun down if they wanted to like take down the website. So Liquidity, in my opinion, is what you should look to as the gold star of decentralization. All right, thank you everybody.